Hello, I'm Sue Cox and welcome to this video on how does pensions and gifting contributions affect income tax. In this nice short video, I'll be looking at the two different ways of contributing to pensions. These are called relief at source and the net payment method. Next, I'll cover the two ways of gifting, which are called gift aid and payroll giving. And lastly, I'll be looking at how we calculate adjusted net income, which is really important for the AF1 exam. Pensions are amazing saving vehicles that have great tax advantages. If you contribute into a registered pension scheme, the government rewards you for taking responsibility for saving towards your retirement, and they give you tax relief. Now, the amount of tax relief that you'll get is based on the highest rate of income tax that you pay. So if you are a basic rate taxpayer, you will receive 20%, higher rate 40%, and additional rate taxpayers will receive 45%. If you contribute to a private pension or your employer offers a relief at source method, then only 20% of tax relief is paid into your pension. Higher and additional rate taxpayers would need to complete a tax return to claim the further tax relief. To calculate the further tax relief, the pension contribution is grossed up, and then this amount increases the income tax bands. It means that more of the individual's income is taxed at the lower rates. If, however, you are a member of your company's occupational pension scheme and they have a net pay arrangement, well, you'll receive the full tax relief immediately. And this is because contributions are deducted from your salary before income tax and national insurance are calculated. Let me show you an example of how the relief at source works. Hannah has taxable earnings of £60,000 and also contributes £50 per month into a personal pension. She'll automatically receive 20% tax relief at source, which will go into her pension pot. However, she is a higher rate taxpayer and would be entitled to a further 20%. She'd need to complete a tax return to get this. The contribution that she is paying is net, and this would need to be grossed up. £50 divided by 0.8 equals a gross contribution of £62.50 per month. Multiplied by 12 equals an annual contribution of £750 gross. To get the further tax relief, the £750 would need to be added to the basic rate band. And this means that more of her earnings will be taxed at 20% rather than 40%. Her earnings benefit from the further tax relief. It doesn't go into her pension pot. The next slide is very quick indeed. If a client does gifting, then they are treated exactly the same way as pensions. Gift aid is treated the same as the relief at source method, which of course means increasing the tax bands. Whereas if the client gifts via their company, which is called payroll giving, then the full tax relief is given at source, and there's no need to claim any further tax relief. In the previous video, I introduced you to a template for writing out your income tax calculation, which also had some built-in warning signs. One of those warning signs was for the total gross income from all sources. I mentioned in the previous video that if an individual's gross income was in excess of £100,000, then their personal allowance would be reduced. However, if the individual made contributions to pensions or gifting, then their adjusted net income would need to be calculated. And this is because the personal allowance is based on the adjusted net income and not the individual's total gross income. To calculate the adjusted net income, we take the gross income from all sources and deduct the gross pension and gifting contributions from it. This will then give the individual's adjusted net income. And this means that you could earn in excess of 100,000, but by contributing to pensions and gifting, you could still get back some or all of your personal allowance. Let me show you how this works with an example. My total gross earnings from all income sources is 110,000, and I also contribute 8,000 per annum into a personal pension. The first thing that we need to do is gross up the personal pension. 8,000 divided by 0.8 equals 10,000. We then deduct the gross pension contribution of 10,000 from the total gross earnings of 110,000. So this means my adjusted net income is 100,000. This isn't in excess of £100,000, which means that I would get back my full personal allowance. And when I calculate my income tax liability, I can also increase the basic rate band to get back my further tax relief of 20%. As I said at the start, pensions are amazing. Last slide for this video. Adjusted net income is also used when we calculate the child benefit charge. If the individual's gross income is between 50,000 and 60,000, then they will suffer a child benefit charge. And the child benefit that they receive may be reduced. If the gross income is greater than 60,000, they would suffer a 100% child benefit charge. And this means that they would lose all of their child benefit. However, don't forget, it's the adjusted net income that's used, not the gross income. Which means if the individual contributed to pensions or gifting, they might be able to get some or all of that child benefit back. And that brings us to the end of this video.